You gave an interview, you were quoted in an interview with AP yesterday as saying that consumers are spending at the fastest pace you've ever seen. I mean, quite the statement. Talk us through what you're seeing, and is that purely in a good way, or is there a risk of overheating a bit?
Well, I think it's always good if consumers are active because that helps drive the U.S. economy, and it's part of why we are who we are as a society and a country. But if you really, just to put it in perspective, you have to think about the turn from 18 to 19 to 20 to 21. 18 to 19, it accelerated during the year, but got about 10% higher than it was in 18. And so that was sort of your baseline. Pre-pandemic, economy growing at 2%. It picked up from, say, 6% growth to 10% growth. Now, importantly, that's across all kinds of spending, not just debit and credit cards. That's only about 25%, but cash and checks and what people spend money on. It'll total $3.6 trillion this year, to give you a sense. So it's a big number. So obviously, it fell in the early part of 20, then picked up. And by this time in 20, it was about the same as it was in 19. And now, this year, it's 20% plus over where it was in 20 and in 19. So twice the growth rate, reflecting the economy growth. And by the way, in the first part of December, it's actually going faster too than it did in November. And so that means consumers out spending the money that came through the stimulus, just spending the extra cash flow they have, and the unemployment's down, and that's good for the economy.
So I mean, you always have that very live data, as you mentioned, with early December. So Omicron hasn't slowed it down at all. It hasn't.
Interesting enough, like in the month of November, compared to 19 to 21, millennials and Gen Z's spending at restaurants was up like 40%. So even when you think that we've closed down and opened, during November's there, and you haven't seen any impact in December at all from the virus. Now, we'll see if it all comes down to what the societal remedy has to be in order to curtail activities, and knock on wood that the vaccines and all the work they've done to win the war on the virus and all the great science and everything's gone through, we'll keep it under control.
And I mean, clearly, there's a lot of inflation out there at the same time, and consumer spending is just one of the inputs creating that. PPI this morning, again, incredibly hot. To what extent do you think that the Fed is at risk of being significantly behind the curve on that front?
Well, you just asked me a question about the new variant and what's going to have. That's the problem they've been dealing with. What traditional view would be, you'd have the recession, you come out of it, and then you could sort of predict life, or at least try to predict life. Now with this variant, it's caused differences. They've held on longer, but they put between the fiscal stimulus and the monetary accommodation, just a ton of money went in the economy. In those consumer accounts at Bank of America, they have, November was the first month that the balance, people carried like an under $5,000 balance before the pandemic, have carried 3 to 8 times bigger as you go down lower. It was the first month in the $2,000 in accounts, they drifted down just a hair, 1%. They've been growing every month since July. So what the Fed looks at is, is this a temporary thing in the sense that the stimulus gets spent and it reverts to normal? And what you're seeing is this is hanging on. So I think they know they have to do their job. Chair Powell's been clear about it 2 weeks ago in front of Congress. He was clear about it. So how they do it, will be a judgment based on what they know at the time, but everything would support that they can start to normalize monetary policy. They've said it, and they'll start doing it probably tomorrow.
If we do see hikes early next year, for example, or by the middle of the next year, are you relaxed about the effect that will have on the economy, or is stagflation a genuine risk?
Yeah. All of them are risks, and there are a lot of different risks. But if you think about our economists have this year, it's around high 5 point something percent GDP in the U.S. Next year, 4.2, 4.3, and the next year 2.2. So 22 and a 4, and then 2. Just think 6.42 to make it simple. That reflects the tightening to come in to bring the economy back sort of to trend growth and things like that. So I think most of the economic predictions are assuming the Fed raises rates next year and it cools the thing down. Could they overshoot the other way? They could. They won't try, but they could. But if anybody wants to think about this Fed in 2019, with an economy predicted to grow at half the rate, with the same size, with unemployment at 3.6 versus 4.2, had the Fed funds rate at nearly 2%, and you had a flat yield curve because of what was going on in the markets. So there's not a mystery of what they'll do. The question is when and how and at what pace based on what they see every day. And I think where the market will get really worked up is at March or is it June. The end of the day is it'll come pretty quickly, but they'll normalize carefully.
And credit quality has remained unbelievably calm and benign. What areas do you keep an eye on daily for that changing? you're a little bit worried about?
All of them. I mean, we're paid to worry at the top of these large corporations, these large banks, and we have capital liquidity and made it through the crisis, and we stress test every quarter. But you worry about all of it. And, we have a balanced book between commercial and consumer, and it's growing well. We grew at, I think, 8 or 9% annualized growth rate in the third quarter. We've seen that carry forward in the fourth quarter. So you're seeing people borrow. But credit quality is very strong, especially on the consumer side. And, given what we see, it should stay strong. Do we look at it all and worry about it? Yes. Are you worried about housing prices have gotten too high and the impact rates will bring that down? Sure, you're worried about all that, but you don't see that having a big impact on credit in the near term just because we think the Fed can ease back into this. And the amount of stimulus in people's accounts, the amount of the unemployment being at 4.2 already is a pretty good bearing on people who earn the money, can spend it, and now keep the economy going.
When you look at the enormous growth in buy now, pay later, is that something that you feel like you missed a trick on at all?
Not really, because it's a different way for people to pay. And so it's been enormous growth, but maybe not in the context of a company that has, $80 billion in credit cards and, $200 and some billion in mortgage loans and home equity loans and auto loans, and it's grown from zero to something. And it's a product that's designed. It's a deferred payment. It's not a new product. The installment deferred payment zero interest loan's been around for, I read one article, 500 years. But maybe let's just take it since I've been around banking. So, and we'll bring out products. We have a product that is similar, and we'll bring out some products to sort of meet that customer need. But especially when you play in the real prime space, it's a product which is a little different for us as a company, but we'll have it here in the next several months, and we'll go to war in competition.
I mean, it raises another question as to whether the consumer in general, not necessarily Bank of America clients, but whether the consumer's over-leveraged, or put another way, with all that we've been discussing, whether we will look back on this period of stimulus, both on the fiscal side and the monetary side, and these new products that have enticed people to borrow more, and reflect on that for the next decade of having to unpick excessive leverage.
Well, that always happens at the edges. So the question of these types of products, are they inciting people to borrow beyond their means? The difference is think about how much money is in people's accounts and they can carry it, and think about the unemployment level. So what stops people from paying loans is when they aren't employed. And, as a large credit card company, looking at it for many years, at the end of the day, people either get sick or unemployed, get divorced, or something like that happens. They don't just stop paying. And so the reality is that their borrowing is more by the economic conditions around them, and unemployment is low and expected to be low for a good long time here.
And so when we sum all of that up and see how it's reflected in markets, record closing in on Friday, obviously we pulled back a little bit over the last couple of days. In general, are those levels justified based on what you're seeing? This is still a pretty healthy environment.
It's a healthy environment. Bank of America stock is always cheap, but other than that, it's a healthy environment.
Up today in a down market.
That's what it's supposed to do. But I think, look, there are evaluation questions, and you see our strategists raise them about our areas, too high a multiple earnings as earnings growth rates slow down, because they have to slow down because there's a recovery period, and that'll play itself out. But I think the other thing is, remember, the wealth effect created by housing and all this stuff helps the consumer, but you have to be careful it doesn't go too far. And what we don't see is leverage in the wealth management platform at anything near what it's been before. We don't see leverage in housing. The structures of underwriting have been pretty under control. People aren't, frankly, our home equity lines are down at lowest levels in many years, largely because people paid them off with long-term debts. They have 30 years to pay back. So the consumer's pretty well structured. And there's pockets that you're always concerned about, but generally, the advice I give you or anybody else is just follow the unemployment. Where you think there's going to be unemployment, that's where you're going to have consumer credit problems.
In terms of Bank of America itself, I mean, it's an interesting snapshot that today the stock is up on a down day. I mean, the prospect of rising rates, provided it's not too sudden, too fast, derailing the economy, must be something that you have been looking forward to for years, and it's going to, I guess, deliver a lot of operational leverage for you.
Oh, it delivers leverage, and so that's what happened in 17, 18, 19, and then the pandemic, and then they went down. And so, unfortunately, for most of my CEOs, which is closing 12 years, I've had a rate structure which is basically zero on the front end. But we've learned how to operate the company well. The team's done a great job. We made a lot of money. But we have $2 trillion in deposits, and we have $1 trillion in consumer, and it's largely checking. And So when the rates go to zero, you hit a zero floor, and that then takes away some income. When that goes back up, the consumer team will make more money, and they do a great job, and they run a great business. It has different impacts in the commercial book, or rising rates can slow down the economy. But in the consumer deposit space, that's where we get all leverage, because frankly, we're deposit insensitive as opposed to asset sensitive. That's the technical word that describes rate movements. But our estimate is low $7 billion per year with a 100 basis point increase in rates. And we captured $1 billion in net interest income last year to the third quarter almost, and so we can capture it in a flat rate environment too.
A lot of places to fill on the Fed, and we're expecting some announcements in the coming days on that. If it changed the overall take on how banks should be regulated, would that be a big mistake? And would it be unfair? Do you guys not get enough credit for in fact, the way you've helped the economy?
Fairness, I'll let people like you describe what's fair. Look, in the end of the day, we have an industry in this country which is the best in the world. And it's the best capitalized. It's run the best by my colleagues that do a great job, and our company does a great job. And what it did through the crisis is, we did PPP, we did consumer not having consumer deferrals. We did 2 million of those. We did 500,000 PPP loans. We did $70 billion of borrowing from our commercial clients in 4 weeks. We helped stabilize the markets. And so all that is powerful because of capital liquidity. The work that was done, all the way through from the financial crisis through Dodd-Frank and through the rules interpreting and under the Fed and the Obama administration, everything, all that's still there, and it protects them. And so I think we should sit back and say the banking industry's done a good job. And then it's always, here and there and debates about things, but the reality is that this industry has done a great job for America to support it through a very difficult time.
I want to touch on the back-to-work rules and regs for various different companies. Some of the pure investment banks took a harder line on that over the summer. Do you feel vindicated that you kind of straddled it somewhere in between, given how much this virus is prolonged?
No, we always looked at it as a very pragmatic. It was going to be tough to manage an environment where everybody wasn't vaccinated because the restrictions are going to have to be. So think of a trading floor. If you had partially vaccinated, unvaccinated, somebody had to literally walk down the line and say, you have to wear a mask, you don't. But by the way, I wasn't allowed to tell them who was vaccinated.
Right.
So how could we actually do it? So we just said, let's stick to everybody in administrative buildings and trading floors, get vaccinated, come to work, and everybody else could work from home. And we've been true to that. And so all the back to work is around that. So we've brought back 60–70% of the U.S. population back to work. And, a given day, people have flexibility and do things. But the reality is they're here and working. And the branches, which have done a tremendous job to support the American public during this time, have been open every day. So that's a different thing. And so we feel good about what we've done. But we focused on, getting our teammates safe and vaccinated and getting them back to work when they're ready. And so people have different strategies, but the key strategy was we focused on making sure that people could, when they came to work, could operate pretty much. So you go down on our trading floors, the people are there trading and it looks good. And that's what we wanted. We didn't want people to sort of operate in a hamstrung environment. Now that happens once in a while. You have to wear a mask in the hallways and stuff because that's the rules of the road.
Well, we've done an interview on your trading floor before, but I'm glad we came up for this view today. You made a number of leadership changes over the summer, and a couple of things came out of that. One of them was that you said you suggested you'd be in charge for most of the rest of this decade. Of course, you took over in 2010. You really want to hit the 20-year mark?
We have a great team, and it's fun to work with them. And this company does great things. It delivers profits. Our 1, 3, 5, 10-year shareholder returns are tops in industry and beat the S&P and all that stuff. And we deliver for society with the work we do on charitable work and sustainable finance and things. So we believe that we can do great things here. And so it's a fun company to lead in. The team's great. Now, we had some great teammates retiring here in a couple of weeks, Ann Fanuc and Tom Montag and Andrew Smith. These people have worked at the company 70+ years on a combined basis and made this company successful. But the best thing they did is develop a great team behind them. And so we have been working on this for the last couple of years because of, and so I feel good about it. I always say to people, the happiest CEO I know is Mr. Buffett, and he's 90, so I'll see what I can do.
The other thing that came out of it were that now 3 of your 8 business lines are led by women, and you have another 4 direct reports who are women. And we spoke about some of these changes at the Women's Forum of New York recently at a panel. I just wondered to what extent you set that target of wanting to be here for up to the rest of this decade so that you could ensure your successor could be a woman, or am I reading too much into it?
I think you're overreading. We have a deep succession planning process that we go through every 6 months of the board that alternates between the senior-most people and then sort of the process around the rest of the people, and then I do it multiple levels down. So we're always looking. And I think, as you look forward to my succession, the board will pick somebody. My job is to have many people prepared, and they can sort of see what they're thinking about, and they can watch the people in action. So we just did our board offsite in Arizona, and we had 70 management team members there with the board, and you just want them to be exposed because they need to know who's qualified. They need to know. Now, we have a big activity between Sherry Bronstein and myself to deliver it into that process so they can see it. But there's people always say that we have talented women, we have talented men, we have talented minority, and that's the goal. But that's many, many years of development through the cycle, and that's what we're trying to do.
Brian, always a pleasure to catch up. Thanks for having us here today, and thanks for joining us.
It's a pleasure, Wolf, and happy holidays.
And to you. Guys, I'll send it back.